Friends, as I said that as an annexure to the auditor's report, there is a mandatory requirement of reporting on the internal financial control, and therefore you will find that in the main auditor's report there is an annexure, either annexure A or annexure B as the case may be, giving a separate report by the auditor on internal financial control. This is a recent amendment pursuant to the amendment made in the Companies Act, wherein the statutory auditor of the company is required to give his report on the internal financial control of the company. This report is a very important report, friends, as it deals with internal financial control framework of the company, which mainly pertains to financial reporting, and financial reporting mainly pertains to financial statement assertion with respect to completeness of the disclosure, existence and occurrence, rights and obligation, valuation, presentation, and disclosure. It also deals with various controls with respect to authorization of certain transactions, safeguarding of the assets, and maintenance of the complete and proper records by the company. Therefore, the report of the statutory auditor on internal financial controls deals with financial statement assertions as well as various controls, whether all those assertions and controls are in place in the company or not. The next in line, which is the part of the internal financial control, friends, is the business cycle, the various processes, objectives, and various activities. All those aspects are covered by the auditor while reporting the internal financial controls in the separate report known as Report on Internal Financial Controls. So therefore, friends, one has to read carefully the report on internal financial control as given by the statutory auditor, whether there exist proper internal financial controls or not. Any adverse opinion indicates an early warning sign, red flag, or in a case of a clean report indicates strength and good governance in the company. Friends, similarly, as an annexure to the auditor's report, there is a separate auditor's report known as Company's Auditor's Report Order, which is in short referred to as the CARO report. CARO report is a very important report and it is a part and annexure to the main auditor's report pursuant to section 143(11) of the Companies Act under which this CARO report is issued. Let me take you to the background of the CARO report, friends. Initially, in the year 2003, Government of India has notified certain regulations. Accordingly, only the manufacturing companies are required to obtain a separate report from the auditors, and therefore earlier it was applicable only to manufacturing companies. Having realized the importance of this report, the Ministry of Corporate Affairs has expanded the scope of CARO report, and presently CARO reports applies to all the companies may be manufacturing or may not be manufacturing, meaning thereby even if a company is a trading company, even if a company is into the hospitality business, even if a company is into the infrastructure or IT enabled services, the CARO report is applicable. But there are certain categories of the small companies which are being exempted from the CARO report, but mainly CARO report applies to all the companies. Accordingly, this report is a statement of fact. It is not an opinion because under this report, the auditor is required to disclose the actual information. As I said that this report, CARO report, is designed keeping in view the interest of the stakeholders, and the stakeholders inter alia includes management, shareholders, various regulatory authorities, public at large, various lenders, etc., etc. And therefore, keeping in view the interest of all the stakeholders, this CARO report has been designed, wherein on the various clauses, the statutory auditor is required to furnish information on the various clauses of this report. Presently, friends, there are 16 clauses under which the statutory auditor is required to provide information under each of the clause as comprises in the CARO report. There are total 16 clauses, and all those clauses have been regrouped for the purpose of this presentation into the loans given to related parties, default in making payment of undisputed statutory dues, details of disputed statutory dues, default in repayment of dues to banks or financial institutions, contracts or arrangement with related parties, maintenance of the proper records of fixed assets, compliance to Section 185
It's
and 186 of the
6:45.
Companies Act 2013, and if there is a non-cash transactions with the director or connected persons, the information is required to be provided under the Caro report. Friends, as I said, the Caro report is a very, very important tool and it is an annexure to auditor's report and therefore it is signed only by the auditors and not by the management. Please read carefully each and every clause of the Caro report because it deals with whether proper records of the fixed assets had been maintained by the company or not, whether the fixed assets had been physically verified by the management or not, whether all the title deeds are in favor of the company or not. Similarly, if a company has given loan to a related party, the complete details thereof is required to be made available in the Caro report. Further, where the company has made default in making payment of undisputed statutory dues, it is reported in the Caro report and therefore any default in making payment of undisputed statutory dues is an early warning sign and a red flag. Because whenever the tax has been collected by the company, it is a regulatory requirement that on a due date, the amount is required to be paid into the government treasury, and any default or any delay indicates that the company is facing financial difficulties, and that is why the funds of the government in the form of TDS, in the form of deduction from the salary known as PF, ESIC contribution, etc., has not been deposited by the company in due course in the government treasury. Therefore, friends, one has to read carefully each and every clause of the Caro report and understand whether some vital information, some red flag, or some important issues is disclosed in the Caro report or not by the auditors. Friends, since the balance sheet is one of the most important part of the financial statement, the various items of the balance sheet comprising of assets liabilities has been explained in details in this part. There are various items of the balance sheet which plays an important role for the purpose of analysis, such as if a company has made investment into the fixed assets, the most important part is whether these fixed assets has resulted into the required production or just the investment has been made by the company. Therefore, by looking at the investment into the plant and machinery, it is equally important to look into the corresponding production by the company. And therefore, let us say in a particular year for which you are analyzing the financial statement or you are on the board of a company and the company has made certain proposal for the purpose of investment into the plant and machinery. And if this investment is a substantial amount of investment into the plant and machinery, then naturally the correspondingly there has to be increase in the production and therefore may not be in the year under consideration, but at least in the subsequent year there has to be correspondingly increase in the production commensurate with the investment made into the plant and machinery of the company. Because any investment into the plant and machinery requires huge resources of the company, and therefore it is very essential to correlate one part of the financial statement with the other part of the financial statement. Similarly, for example, let us say that company has certain intangibles. All those intangibles are patent, trademark, copyright, goodwill, computer software, mining rights, etc., etc. So therefore, if a company is showing huge investment into intangible fixed assets, you have to keep in mind the nature of the industry so as to justify whether these intangible fixed assets are reasonable or not, or whether they have been properly disclosed by the company in the balance sheet. Let me take you further on the analysis of the balance sheet. Let us say company has made investment into the various types of shares and securities, including investment in subsidiaries, associates, joint venture, etc. All these investment are shown in the balance sheet on asset side of the company as an investment. Therefore, the objective, the purpose, and critical examination of the various factors relating to investments are equally important to ascertain. The diversion of the funds is explained is and found by reading at the what is the investment made by the company. Similarly, the loans and advances may be long term as well as short term are required to be disclosed under the head loans and advances. By properly analyzing the loans and advances, coupled with the fact the various informations as disclosed by the company in the notes on accounts with respect to related party transactions, you may come across that the loans and advances may include, or in a given case, the majority of the loans and advances may be pertaining to loans and advances given to related parties. So therefore, all such loans and advances as shown under the head loans and advances are required to be analyzed and looked into along with information as disclosed in the notes on account relating to related party transactions. Similarly, if the various disputes are going on by the company which has been disclosed by the company as contingent liabilities, and as a part of all such disputes, the company might have deposited certain amount with the government authorities, and all such amount are required to be shown as amount recoverable in cash or in kind. So therefore, all the disputes are required to be seen along with the amount which has been deposited by the company. So this is what various amount shown by the company and in the balance sheet as various amount recoverable in cash or in kind. Another important part of the balance sheet is the friends, the various inventories and the trade receivables. Inventory may be comprising of raw material, work in progress, finished good, stores and spares, packing material, goods in transit, etc., etc. So therefore, when one is analyzing the financial statement balance sheet of the company, one need to look into the quantum of inventory with respect to the business of the company. Let us say the business of the company is 1,200 crores of the sales for the year, meaning thereby on an average monthly sales is rupees 100 crore. And if a company is showing raw material inventory of let us say 300 crore rupees, meaning thereby equivalent to 3 months of the sales, raw materials is the holding period. Similarly, friends worked out what is the work in progress, what is finished goods, and on the basis of sales made, how many months of debtors are outstanding, so as to find out whether what is the operating cycle of the company and which are the various components, which are the various items of the inventory, work in progress, and finished goods. And if a company is having huge inventory coupled with the fact that huge trade receivables, meaning thereby company is also having huge inventory and on the other hand they are not in a position to realize from the debtors within a due course of the period of time. By looking at the trade receivables, you can find out what is the average collection period, which is also equally very important and relevant. Coming on the liability side of the friends, the shareholders fund or the capital which has been raised by the company is of very important and very essential to ascertain. The shareholders fund, who are the major shareholders, whether such shares have been pledged by the company or whether the shares are free by the promoters, etc., is a very important analysis into the share capital of the company. After share capital, there are certain reserves and surplus, which are those reserves and surplus, what is shareholders fund, what is EPS, all this is required to be analyzed, which is clubbed under the separate slide of shareholders fund. After shareholders fund, the company might have taken certain loan from the banks, certain borrowing from outsiders. All those borrowings, all those loan, maybe debentures, maybe foreign currency convertible bonds, maybe secured loan, maybe unsecured loan, maybe loans and advances, etc., are required to be shown under the heads of borrowings and loans and advances, which is also critically required to be examined. Having examined all those aspects, friends, there is another liability which is required to be shown by the company under the head trade payables. Trade payables meaning thereby if a company has purchased goods from the market and to the extent the creditors has not been paid and the amount which remained outstanding is shown as trade payables. By looking at the purchases which amount of trade payable, a link can be found out between the purchases and trade payables. And this link can be compared with the previous year whether the trade payables are in line with increase in purchases or the trade payables has been decreased. Therefore, friends, on the holistic view of the complete balance sheet, what are the assets, what are the liabilities, what is current assets, what is current liabilities, what are the long-term assets, what are the long-term liabilities, one has to take a view whether company has sufficient funds, sufficient resources available in the form of current assets, so as to meet the present obligation, the current liabilities, etc., etc. Therefore, friends, the analysis of the balance sheet is very, very important, and the complete analysis of the balance sheet will indicate the business model of the company, whether the business model of the company will keep the company going forwards, or the company has made huge investment into the plant and machinery but not able to generate sufficient production, or company has made huge investment into the subsidies but not able to generate good returns from the investment made into subsidies, or company has huge inventory of the materials and not able to liquidate it, or the company has taken huge borrowings not commensurate with the current assets available, etc., etc., are very, very important and vital for the purpose of analyzing and reading the balance sheet of a company. Friends, after the balance sheet, friends, the next important item is the how to read the statement of profit and loss. The statement and profit and loss, as we all know, comprises of the full year as against the balance sheet which is on a particular date. Meaning thereby, the balance sheet is prepared on a particular date, that is 31st of March of every year, whereas the statement of profit and loss comprises of information of sales, purchases, various expenses, profit earned, tax expenses, depreciation and amortization for the period from April to March, that is of 12 months period. And therefore, the analysis of the statement and profit and loss is equally important and very, very essential as the analysis of the balance sheet is. The one has to look into the various sales which is shown on credit side of the statement of profit and loss, meaning thereby what is the total sales, which are the sources from where the revenue has been generated by the company, whether these revenues is from core operating activities or from non-core operating activities. This can be known by reading into and making the detailed analysis of the note annexed to statement and profit loss account, wherein the complete details of the revenue from operation is provided by the company. On further analysis, one may find that which are the various components in which the company has been dealing with, whether it includes certain trading sales, whether it includes manufacturing sales, etc., etc. After the revenue from operation, friends, there is another important item which is income from other sources. And normally income from other sources comprises of dividend and interest income. But apart from dividend and interest income, there may be profit on sale of fixed assets, maybe commission income, maybe corporate guarantee commission income, maybe miscellaneous balances written off, etc., etc. Therefore, the critical examination of all the items as shown under the head income from other sources is also equally important and relevant. Coming to the debit side of the profit and loss statement, which are the purchases made by the company, what is opening inventory, what is closing inventory, and what is the movement with respect to opening and closing inventory. Meaning thereby, if the inventory has been increasing, whereas the sales has been decreasing, it indicate an early and important early warning sign of the company. Similarly, which are the various items which has been purchased by the company, which are the various items of raw material which has been consumed by the company are also equally relevant and important to look into. Thereafter, having understood the various components of the sales and various components of purchases made, various components of the raw material consumed, one need to find out what is the percentage of cost of raw material consumed with respect to manufacturing sales. And if there is no change in manufacturing technique and there is no change in product mix in a case of a company, normally the manufacturing cost should be more or less equal to earlier years. Moment you find material changes in the cost of raw material consumed as a percentage of the sales, you need to look into the further details why there is much movement, why there is so much variation in the cost of material consumed as compared to earlier year, whereas there is no change in product mix, there is no change in manufacturing technologies, etc., etc. Next in line, friends, is the looking into the power and fuel. Power and fuel is a very, very important tool, and by looking into the cost of power and fuel, one can compare and look into the manufacturing sales. If manufacturing sales has increased by, let us say, 20% in this year as compared to earlier years. The power and fuel, unless the rates of power and fuels has gone under change, the power and fuel expenditure should also be higher by at least close to 20% as compared to earlier year. Then always calculate
It's
what is
7
the
o'clock.
operating margin, meaning thereby what is the gross profit earned by the company on the purchases, sales, opening stock and closing stock, considering all those aspects. Thereafter, friends, there are various components of the expenditure as debited in the profit and loss account, which is also required to be critically examined by the company. For example, if a company is paying huge commission, there are liquidated damages if a company has contributed substantial amount towards political parties, if a company has given donation, or if a company has incurred huge expenditure into litigation. All those aspects can be known by critically examining the various components of the profit and loss statement under the head various other expenses. Then what is the interest cost which the company is incurring? By looking at the interest cost, one can find out whether the company is highly leveraged or not. For example, if the interest cost as a percentage of sales is close to 10 to 15%, meaning thereby if the profit margin is say 20% and if the 10% or 12% is the finance cost of the sales, meaning thereby half of the operating margin has just gone in servicing the loan, which indicates that or which may lead to a conclusion that the company has taken huge loan. If it is in the initial phase of the production, one can understand the huge finance cost, but when the production or manufacturing facilities has been stabilized, the finance cost should be commensurate with the cost with the profit margin with the operating profit margin. Huge finance cost with respect to profit margin or operating profit margin indicates that the company is highly leveraged and there may be circumstances, there may be chances that in the subsequent years company may not be able to service the loan. Friends, it is also equally important to look into the depreciation and amortization. What is the amount of depreciation provided by the company? What is the amount which has been amortized out of various intangible fixed assets of the company? Then, friends, one should also refer to the significant accounting policies as to what is the method of depreciation, what is the estimated useful life, how the depreciation has been calculated, on what basis depreciation has been provided by the company, whether the amount has been provided as per regulatory requirement, whether the proper method of depreciation has been followed by the company, etc., etc. Thereafter, friends, the profit before tax and the tax expenses need to be looked into. Then, in some cases, friends, you may find some exceptional item or extraordinary item which is shown as debit to profit and loss statement. What are those exceptional items? What are those extraordinary items also required to be looked into by referring to the details as provided in the notes on accounts. Therefore, what is the profit after tax? What is the profit after exceptional and extraordinary item? What is the overall operating margin? What is the EBITDA margin? What is the profit after provision of tax? Whether the tax as provided by the company has been paid or not. All these are very, very essential and important part of looking into the statement of profit and loss statement. Friends, as we know that the statement of profit and loss and the balance sheet is prepared on the basis of accrual system of accounting. As per the Companies Act 2013 as well as Old Companies Act of 1956, it is mandatory for every company to follow accrual system of accounting. Under the accrual system of accounting, revenue are reported in the statement of profit and loss when it is earned, and further expenses are required to be matched with the related revenue. Therefore, in the accrual basis of accounting, the receipt of amount against a particular transaction has no relevance. Considering the importance of the cash flow statement and the shortcoming of the financial statement, as the same is prepared on the basis of accrual basis of accounting, irrespective of the fact whether the payment against the sales is received or not, cash flow statement has assumed a greater importance. For the purpose of analysis of the financial statement, particularly for the purpose of credit decision by the bank or financial institution, the most relevant factor is the collection out of the sales and not the sales. The repayment of the term loan as well as service of the loan, if any, taken by the entity from the bank or financial institution is out of the recovery of the revenue from operation and not from the revenue from operation. Therefore, the banks, financial institutions, and the stakeholders have started using analysis of the cash flow statement very frequently for the purpose of analysis and understanding of the financial statement as an advanced tool. More particularly in the recent time when a large number of banking loan fraud started reporting, reliance is also placed on the analysis of the cash flow statement. Cash flow statement is prepared on the basis of actual movement of the funds and is divided into three parts based on the nature of activities. That is, cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Out of the above three activities, the net cash flow for the year under consideration and the same is matched with the difference between opening cash and bank balance and closing cash and bank balance. So therefore, friends, the cash flow statement is very important. As we all know that the cash flow statement is divided into three parts, that is operating, investing, and financing. Let me explain you the basic concept what is included in operating, investing, and financing activities of the cash flow statement. Under the operating activities, friends, the entire operations of the company are covered. That is to say, the complete profit and loss statement. That is to say, the revenue from operations, other income pertaining to operations, various expenditure incurred by the company in the procurement of raw material, procurement of various services, various expenditure incurred on power, fuel, labor, and various expenditure, etc., which is directly pertaining to operations of the company, are reported in the operating activities. From balance sheet, trade receivables and inventories, since it is pertaining to operating activities, also forms part of the operating activities of the company. Similarly, if purchases are made and the creditors has not been paid, the same is being reflected into the trade payables. So therefore, the trade payables as shown on liability side of the balance sheet also forms part of the operating activities of the cash flow. So far as investing activities of the cash flow statement is concerned, entire asset sides of the balance sheet excluding trade payables and receivables which is pertaining to operating activities forms part of the cash flow from investing activities of the company. And similarly, various loans taken, various borrowings, various infusion into the capital, various amount contributed by the promoters, various amount received towards the share capital of the company, various loan received, etc., forms part of the financing activities of the company, which is taken into the cash flow statement. So therefore, the entire balance sheet and profit and loss statement is divided into operating, mainly pertaining to operations, which is based on profit and loss statement, investing, which pertains to various investment made by the company, which is mainly pertaining to asset sides of the balance sheet, and financing, meaning thereby various source of the finance, which is mainly pertaining to liability sides of the balance sheet of the company. Therefore, by looking at the complete operating, investing, and financing activities, one can find out whether there is a sufficient operating cash margin from operating activities, from where the funds has gone, whether it has been used into investing or whether it has been used into the repayment of the loan as forming part of the financing activities. If the company has taken huge loan, you will find positive cash flow from financing activities, and if it is used as investment, you will find negative cash flow into the investing activities of the company. If the company is incurring losses from operating activity, so far as cash flow statement is concerned, you will find negative operating cash flow. Negative operating cash flow is an early warning sign, and in a company if year after year company is reporting negative operating cash flow, then it is an early warning sign and to be looked into critically. Friends, the next importance is the significant accounting policies. As we all know that significant accounting policies are required to be disclosed as an separate information in the financial statement under the head significant accounting policies. Therefore, the analysis of the significant accounting policies is very essential and equally important as analysis of the balance sheet and financial statement and statement of profit and loss statement. An accounting policy is very important for the analysis of the financial statement of an entity, as I said, because the accounting policy disclosures helps in preventing misrepresentation in the financial statement, and any policy which is not as per generally accepted accounting principles is required to be disclosed appropriately and separately in the financial statement. The standardization in the reporting allows company and entity business with other business entities and business of the similar kind, and therefore it is very important and equally relevant to disclose the significant accounting policies so that the same can be compared with the other business. Virtually presentation of a true and fair view of the financial statement is achieved by complying with the applicable accounting standards, generally accepted accounting principles. Presentation of a true and fair view also requires an entity to select and apply accounting policies in accordance with Indian accounting standard known as Ind AS 8, that is accounting policies, changes in accounting estimates and errors, etc. Friends, there are various significant accounting policies which are normally disclosed under the head significant accounting policies as annexed in the audited financial statement. And these policies inter alia include the basis of preparation and presentation of the financial statement, which estimates has been used, under what circumstances estimates has been made by the company, what is current and non-current classification, and what is operating cycle. Similarly, the complete disclosure with respect to tangible and intangible fixed assets is also separately disclosed under the head significant accounting policies. As we all know that depreciation and amortization is an equal important part of the financial statement, and therefore what is the significant accounting policy with respect to depreciation and amortization is disclosed separately. If a company has taken certain assets on lease, what is the lease policy, how the disclosure is made, and what is the relevant requirement, etc., is also separately disclosed in the significant accounting policies. What are the method of valuation of inventories? As we all know that there are different method of valuation of inventories, and therefore the same is also separately required to be disclosed under the head valuation of inventories. We also know that if a company has made certain investment, the investment is whether at the historical cost or at the market rate, etc., is also separately disclosed under the head investment. And then with respect to income tax, what is current tax, what is deferred tax, how it is calculated, how it is worked out, is completely required to be disclosed under the head income tax of significant accounting policies. Further, there are various foreign currency transactions, how the transactions has been recorded, etc. Policy relating to that, what is provision, what is contingent liability, and what are contingent assets. In a case of a employee's benefit, complete disclosure of employee's cost, where the company has taken the huge loan, how the borrowing cost has been disclosed in the financial statement, revenue recognition, segment reporting, earning per share, impairment of fixed assets, etc., are very important and relevant significant accounting policies which are normally disclosed by the company under the head significant accounting policies. Coming to notes on accounts, as we know that notes on accounts are also important. It is the Schedule 3 to the Companies Act 2013 which deals with the preparation of the financial statement. Part 1 of the said schedule explains how the balance sheet is to be prepared, and Part 2 explains about the preparation of the statement of profit and loss. In both the part, that is Part 1 and Part 2 of the Schedule 3, general instruction for preparation of the balance sheet and statement of profit and loss accounts are provided. As per the said general instruction, there is certain information which is required to be disclosed by way of notes. Accordingly, These notes forms an integral part of the balance sheet and statement of profit and loss, and that is why such notes on accounts are known as connecting statement. And therefore, friends, since these notes connect the financial statement, it is very important and relevant to read the complete notes on the financial statement. The objective of the notes on accounts is to present information about the basis of preparation of the financial statement, that specific accounting policies are used, and to disclose the information required by the Indian accounting standards which is not prescribed elsewhere in the financial statement, and 4, to provide information that is not presented elsewhere in the financial statement but is relevant for an understanding of the financial statement. And therefore, it is very important to read the notes on accounts, as the objective of the notes is to provide the vital and relevant information which are relevant for the purpose of understanding of the financial statement. Further, friends, as per Schedule 3 to the Companies Act 2013, it is mandatory for every company to disclose by way of notes the additional information as I stated earlier. Therefore, friends, the analysis of the notes on accounts is equally relevant and important, and the analysis of the balance sheet is not complete unless one completely go through and read the every information provided in the notes on accounts. Reading the notes on accounts sometimes provide vital information about an entity, and the object and purpose of reading the financial statement is complete if the significant accounting policies are read along with notes on accounts, and the significant accounting policies and notes on accounts are read along with the balance sheet and statement of profit and loss account. Thank you.